The technicals of crude oil and the technicals of the Bloomberg Commodity Index, which includes energy, grains, meats, base metals, and gold and silver, is such that it looks like it's ready to erupt to the upside for another major up leg. The first major up leg coming out of the bear low. The bear low, by the way, on Bloomberg was in the 50s. Right now, we're trading either side of 100. We got up to 140 back in early 2022. And when that war started, commodities peaked. They didn't go up because of the war. They peaked because of the war. And they pulled back to 100 from 140 on Bloomberg. And then went to sleep now for 2 years, either side of 100. Totally boring. Crude oil's done about the same thing. You can look at about $65 on crude and go back about 3 or 4 years and draw a line sideways. And we've been above it and we've been below it, mostly above it. But it's basically a boring situation. We argue it's basing, that momentum argues you uptick crude oil next quarter to a 68 again, watch out, the lid's going to come off. I don't know what the reason will be. Maybe it's just a cheap asset for too long and money's going to flow into that asset category. Commodities are cheap relative to stocks. Commodity companies are cheap. But the Bloomberg looks set to explode again too. And that would really be an emotional ambush again for the average guy. Not only is 401k going down, but when he pumps his gas, it's gone up 50% or doubled. And that wasn't supposed to happen, right? Okay, we were told that you vote for me, it's not going to happen. The technicals look like it could very well happen. And that will be an ambush factor. That'll help change the world again. Reallocating everybody's notions about what's the truth. Okay. And that's when when you get things like that happen, that ambush people this way, that way, the ways they didn't expect, that's when changes occur. Like, for instance, I bet there's no Federal Reserve in a couple years. We go into this crisis, they're not going to solve it. There's already enough voices out there that doubt it anyway. And not just here, but other countries might reconsider too. Is this central monopoly over money really been valid and viable? Or is it just added to the boom-bust cycle? Another factor. If we go into a major recession, and I think we will, stock market breaks, you will, the public's ability to pay taxes is going to collapse. And already we know that the IRS doesn't collect what it might have expected years ago to collect in terms of percentage of money that the government needs. And even Biden, 3 months, suspended taxes during the COVID crisis. Okay, remember that? It wouldn't shock me that because of its dysfunctionality, its inability to collect. And by the way, cut its labor force by 25-30% recently, the IRS. Your chance of being audited is collapsed. So the ability of the IRS to function as an income source for the government, it may be tossed out the window as well. Where financial emergency situation, the president declares income tax is abolished, we're going to a national sales tax. Things like that could change. Am I insisting that they will? Yeah, I'm not sure which ones will change, but likely those are the kind of events you're going to see that will surprise people, where major institutions and ideas suddenly get sidelined. We watch the 30-year futures have been around for decades. If you go back and look, we turned bearish on T-bonds at a price of 170. That's back in late 2020. They collapsed down into the under 100 in late 2022. Down toward 100. And you can draw a line sideways from October of 2022 across the price action, or if you look at a yield chart across the high levels of yields on the long-term end of government debt. And there's been no relief. It's what looks like a basing pattern on price, where price just refuses to go down anymore. It's had a couple rally attempts in the last 2 years, each of which has been gone up for 4 or 5 months, and then they whack it. It can't seem to get off the ground. When we do our momentum studies, we have 2 levels we're watching right now, because we know that, like Jamie Dimon has made this point, that this time the government debt problem might not be wished away.
When I look at crude oil and the broader Bloomberg Commodity Index, what jumps out isn't noise, it's the setup. The technicals are screaming that this market has been coiling for 2 years, quietly boring everyone to death, waiting for its chance to erupt. And when markets go to sleep for that long, the breakout isn't polite. It's violent, it's unexpected, and it leaves the average investor clutching their 401k statement with one hand while filling up their car with the other, wondering what on earth just happened. Let's get specific. The Bloomberg Commodity Index hit its bear low in the 50s. Today, it's been grinding either side of 100. We had the spike in early 2022, up to 140 when the war headlines were flying, but instead of launching further, commodities peaked with the war. They pulled back to 100 and basically went flat, sideways, boring. But this is the kind of boredom that technical analysts love because it's base building. The longer the base, the bigger the move when the lid blows off. Crude oil shows the same picture. Draw a line at $65, stretch it across 3 or 4 years. Price has flirted above and below, mostly above, but it refuses to collapse. It's a base, not a top. Our momentum models say, watch for a tick back above $68 in the next quarter. That's the trigger. When that happens, the lid comes off. And when commodities and oil launch, they don't creep, they leap. Now, will CNBC tell you why? They'll say it was OPEC, or a hurricane, or some geopolitical squabble. But the truth is simpler. Commodities have been cheap relative to everything else. Stocks have been in a bubble. Bonds have been in a bubble. Tech companies have been levitating on AI hype. Meanwhile, the companies that actually produce the stuff that keeps civilization running, energy, grains, metals, have been left in the bargain bin. Markets don't allow that forever. And when the reversion comes, it's not just an economic adjustment, it's a psychological ambush. Imagine the average worker. His portfolio's sagging because the stock market finally cracked. Then he goes to the pump and gas is $7 a gallon. Groceries double. Heating bills soar. This wasn't in the brochure. He was promised that inflation was transitory. He was promised that voting the right way would solve it. Instead, reality smacks him. That's the kind of moment that changes political landscapes, that topples faith in central banks, that makes people say, maybe this system doesn't work. And let's be blunt, maybe it doesn't. When the Federal Reserve is already distrusted, when voices in Europe are openly questioning the ECB, when Japanese households are watching the yen collapse. Another commodity shock could be the straw that breaks the monetary monopoly. I can easily see a scenario where 2 or 3 years from now, the Fed as an institution is on life support. Not because Congress finally grew a spine, but because markets exposed it as irrelevant. Let me add another layer. If we slide into a major recession, which the leading indicators suggest, government tax revenues collapse. The IRS, which already collects far less than projected, becomes a weak read. Do you think Washington won't suspend taxes in an emergency? They did it in COVID for a few months. They could do it again. Or they might go radical, scrap income taxes entirely, replace them with a national sales tax. The point is, institutions we've been trained to think are eternal are not eternal. Crises rewire systems. Look at the bond market. We turned bearish on Treasury bonds back in 2020 when they were trading at 170. They've since collapsed toward 100. Yields spiked and then nothing. Sideways. A base. Each rally attempt in the last 2 years fizzled. When we do our momentum studies, what we see is not relief, not recovery, but stress. The market is saying we can't climb out of this hole. And when that breaks, it's not going to be gentle. Jamie Dimon himself has said this time, the debt problem may not be wished away. That's not a gold bug speaking. That's the CEO of JPMorgan. When the establishment is echoing what we've been saying for decades, you know the cracks are real.
I think silver is participating with gold. It vastly outpaced gold in that 2020 rally. Silver almost doubled in price, whereas gold went up about $500, which is like 25%, 30% rally. Silver doubled. So into mid-2020, silver had outperformed gold on a percentage basis. But from 2020 through the recent low, the silver spread went from like 1.5% of the price of gold down to 1% of the price of gold, even got below 1%. We divide an ounce into ounce and you find it was 1% of the price of gold. If you go back through 50 years of history and look at that spread relationship, you'll see that when you get down to the 1% level, it's time to buy silver. Okay, it's meaning it's dirt cheap. It's not going to go to zero versus gold. Okay, but then the technicals turned, and so over the last 4 or 5 months, you've seen silver outperform gold. Like for example, back in April, gold hit 3,500. It's gone sideways. April, May, June, July, now August. 4.5 months of comatose but steady sideways. They keep trying to sell it, but then go down. But it also doesn't go up. So it's had a sideways correction, which is, by the way, not the way gold ever tops. Okay. During that time, silver's gone up sharply. Okay. We assess technically that silver's now at a point where it's going to outperform gold fairly dramatically. If you go back over 50 years and look at that same spread, you'll see the number of years it got up to at least 2% of the price of gold was like 21 of those 50 years. So it's not abnormal at all. So from the recent low of 1% to 2%, meaning silver could double in relative value to gold, probably over the next year. Wouldn't be surprising me by the end of the year even. Same is true with the gold and silver miners. They're back into outperform mode versus gold. And if you'll look at gold sideways since April, look what GDX has done, vertical. Okay. So I think those parts of the monetary complex are the place to be right now. Silver, the gold and silver miners. Gold will re-engage, and I think it's going to re-engage probably later this month or next to the upside, where people say, oh, it's awake again. But silver and the miners will be the place to be.
Well, that's exactly where I wanted to go with this is, are there particular breakouts that you're seeing within the precious metals complex that is really confirming that we're in this next stage of the precious metals bull market?
Yeah, they've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50, and then came back up. And in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year, where it was either side of that level, up and down, but really just net sideways.
Since 2024 began, we've seen the metals market in a strange state of suspended animation, with gold consolidating for months on end and silver showing leadership in a way that tells us the real story is just ahead. Silver popped into the mid-30s earlier this year and has been pressing higher, while gold has mostly slept in a narrow band. This is not how tops form. Gold never goes to sleep at a top. It spikes and collapses. A long sideways drift after a rally almost always signals digestion before another leg up. The fact that silver and the mining shares have surged while gold sat still only confirms that the undercurrents are bullish. Markets like to signal before they move, and this is the market's way of whispering to anyone listening that the next burst is imminent. Now think of what that burst will mean. Silver is highly likely to break its old nominal highs near $50, not just touch them briefly as in 1980 or 2011, but to power through into the $60 to $70 zone before it even pauses. Adjusted for inflation, silver would need to be closer to $200 just to equal those prior peaks. The odds are good that this cycle will finally bring that kind of revaluation. And it's not only technical charts whispering this, it's the macro environment. The stock market sits on a bubble built from 15 years of cheap money. The S&P and NASDAQ have staged rallies from the April lows, but the action smells like a broadening top. Fake new highs, creepy crawly upside, and weakening momentum. That's the classic signature of a topping market. When this bubble bursts, asset flows will look for safe havens. Normally that might include treasuries, but this time bonds are broken, yields are stuck high, and the faith in them as risk-free is crumbling. That leaves monetary metals as the lone safe harbor. This is why state governments in the U.S. are quietly rebelling against the Federal Reserve monopoly, declaring gold and silver to be legal tender, in some cases even setting up systems where citizens can pay taxes with bullion. This is not a gimmick. It is a profound statement that confidence in the central bank and fiat money is eroding at the grassroots level. When citizens and states begin to reassert that gold and silver are money, that's a rebellion in miniature. It's history repeating itself. Inflation itself is theft, clipping value from every transaction, every paycheck, every account. A society built on systemic theft eventually collapses. We saw it in the Soviet Union. We see it in the long collapse of empires. The only antidote is honest money. Silver, despite being dismissed as just an industrial metal, has always moved in tandem with gold in its major swings. Its monetary character always reasserts itself in crises. That's why the gold-to-silver ratio, at grotesque levels near 85 to 1, is destined to collapse back toward its long-term historic mean around 15 to 1. That ratio is not just a number, it's a measure of the degree of theft and distortion built into this system. When the system breaks, silver will not just rise, it will slingshot. If gold goes to $10,000, silver at 15 to 1 implies $666. Even at 30 to 1, it's over $300. The precise figure doesn't matter. The direction is what matters, and it is multiples above today's price. We are not talking about a normal bull market where gold and silver rise and then give it all back. The conditions this time are systemic. We're seeing bubbles not just in one asset class, but in everything. Stocks, bonds, real estate. The unwinding will be global, and it will force people and nations to rethink what money really is. Already, China and Russia are experimenting with gold-linked trade settlement systems. BRICS nations are buying metal hand over fist. Central banks around the world are accumulating at record pace. They know what's coming. The West is still in denial, but the East is preparing. What happens when the S&P finally cracks and takes the Nasdaq with it? Investors will seek havens. They'll look for treasuries and find nothing but losses. They'll look for dollars and find a debased currency. That leaves gold and silver. And when that flood of capital seeks the metals, the available supply is a fraction of what's needed. Paper markets like COMEX may try to cash settle, but the physical market will explode as arbitrage drains the West vaults into Asia. All of this tells me the next phase is acceleration. Gold and silver rarely wait for a press release to move. They anticipate. Looking back, analysts will say, "Oh, it went up because of that crisis." But in truth, the smart money was already buying. That's what's happening now. While most investors are lulled to sleep by sideways action, silver and miners are signaling. The ambush is coming, and when it hits, prices will gap higher. So where does that leave us? If you hold physical metal, you're positioned for the revaluation of a generation. If you're waiting for permission from the mainstream to buy, you'll be late. This isn't about chasing dollars, it's about stepping out of the illusion, about holding honest money in a dishonest world. And yes, it will be chaotic. Big cities may struggle, governments may fracture, and systems may fail. But out of the collapse comes renewal. Gold and silver, the most enduring forms of money humanity has ever known, will reassert themselves as the base of trust. And those who saw it coming will not only preserve their wealth, they will become the seed capitalists of a rebuilt, honest economy. That's where we are headed. The illusion is cracking, the ambush is near, and honest money is waiting in the wings. The time to act is before the storm, not after. Because when the system finally gives way, the window to prepare will slam shut, and history will divide sharply between those who saw and acted and those who didn't.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.